Warren Buffett just lobbed a grenade into the property world. 12 short years ago, the Oracle of Omaha bragged that he'd scoop up 100,000 houses if only the logistics made sense. Today, he's doing the exact opposite, dumping the dream of bricks and mortar and telling anyone who will listen that real estate no longer stacks up. When the most consistent market beater in modern history flips from "I'd buy the entire neighborhood" to "it isn't worth the headache," smart investors pause. Because Buffett rarely shouts, he whispers, and fortunes move when he changes tone. So what did he see? Why is he turning his back now? And what does that mean for your plans, your mortgage, maybe even your net worth? Stick around. The answer could decide whether you build wealth or bleed it. Back in 2012, housing was dirt cheap. Foreclosures clogged every MLS feed, and banks practically begged solid borrowers to lock in 30-year loans at 3%. Buffett smelled opportunity. On CNBC, he quipped he'd happily become a giant landlord if it were practical. Headlines ran wild. Warren Buffett says houses better than stocks. And for a while, he was right. Values climbed, rents soared, leverage printed money. Fast forward to the latest Berkshire shareholder Q&A. Same stage, same gray suit, utterly different verdict. "It's so much harder than stocks," he sighed, practically waving real estate away like stale popcorn. The crowd laughed. He didn't. He stressed that the return on hassle has collapsed. If the game no longer rewards the grind, Buffett exits the arcade. Here's Buffett's first red flag: velocity. Stocks trade at electronic light speed. Want 10,000 shares of Apple? Done, settled, and confirmed before your coffee cools. Real estate? Picture the polar opposite. A single home can gulp down 6 months of your life. Touring, bidding, counter-offering, inspecting, renegotiating after the roof leaks during escrow, chasing signatures, praying the lender's underwriter doesn't go on vacation. And that's before the real circus starts. Clogged toilets at 2 a.m., gutters that rip off in a storm, tenants who forget rent because their dog ate the Zelle notification. Buffett joked that you can move billions in the stock market anonymously. In property, every deal is a wedding, complete with cold feet, in-laws, and last-second drama. Add the fact that sellers are emotionally welded to their home's imagined value, and you're suddenly bartering with sentiment, not numbers. A friend of mine, seasoned flipper, summed it up. "I spend 90 days chasing a 9% yield I could match in one click inside my Roth." Buffett's eyebrows practically said the same thing. Most rookie landlords love to brag about cash flow. "My $500,000 duplex brings in $3,000 a month." Sounds great, until reality charges interest. Property tax goes up each time the county needs new stadium lights. Insurance spikes after the neighbor's dryer catches fire. Water heaters quit without notice. AC units age like milk. And vacancies show up when you need money most. Add them up and that rosy cap rate dissolves. Buffett calls these slow leaks because they whisper, not shout. He's watched thousands of investors gross 6% but net 2% after maintenance, management, and the most expensive cost of all, time. Time you can't scale, outsource, or refinance. Time that drags while your index fund compounds in silence. Consider the leverage illusion. Put 50 grand down on a $500,000 house. If it climbs to 600,000, you've tripled your equity on paper. Sweet. But the bank still wants its 7% every 30 days, even if your tenant ghosts. Meanwhile, an S&P 500 ETF could drop 15% tomorrow, then roar back 40% before you find a new renter. Liquidity cuts both ways, but speed favors stocks. People say real estate never goes down. They're wrong, just rare. But scarcity breeds complacency, and complacency breeds ruin. The Great Depression, 1929 to 50s, urban property lost over 2/3 of value. Some cities didn't hit pre-crash highs until Eisenhower was president. Savings and loan crisis, late 80s to mid-90s, rising rates and bad loans froze construction, flatlined prices, and left entire subdivisions half empty. Great financial crisis, 2008 to 2012. Valuations collapsed 30 to 80% depending on the zip code, wiping out generations of equity and nearly toppling the global banking system. Notice the gaps. Decades of calm fish out investors' caution. Then a rogue wave swallows unprepared swimmers. Buffett points out that in each wipeout, stocks fell faster. Yes, but also bounced sooner, handing disciplined buyers outsized returns while homeowners waited years just to break even. Liquidity again. He reminds shareholders, "I could buy blue-chip companies for pennies on the dollar while real estate stayed stubborn, illiquid, and overpriced for ages." In 2009, he grabbed Burlington Northern. By the time many foreclosures cleared courts, that railroad had doubled. Buffett isn't dumping property because he hates hard assets. He's reallocating to arenas where his three superpowers, patience, numbers, scale, actually produce alpha. Stocks let him deploy billions swiftly, harvest dividends instantly, and pivot without drywall dust on his shoes. He can compute intrinsic value precisely. If Coke dips below his comfort zone, he buys truckloads before lunch. If the thesis sours, he exits in minutes. No escrow, no permits, no renters sneaking pets past lease clauses. During the COVID crash, Berkshire quietly plowed cash into Apple while landlords fretted about eviction moratoriums. 1 year later, Apple's market cap ballooned by almost $1 trillion. Rents in most cities were still catching up. Buffett's mantra, "I don't seek complexity when simplicity pays better." Right now, simplicity lives on Wall Street trading screens, not in suburban cul-de-sacs. Truth, very few of us will ever mirror Berkshire's moves. Real estate can still build life-changing wealth under the right conditions. If you nail an undervalued fourplex, finance it conservatively, self-manage shrewdly, and treat tenants like gold, you can absolutely outperform the market. But that success flows from skill and sweat, not the blind faith that homes always go up. Buffett's warning is a flashlight. Shine it on your own deal and ask hard questions. Are you buying because the spreadsheet works after stress testing 8% rates and 20% vacancies? Or because Aunt Linda said rent is throwing money away? Are you adding real estate to diversify a stock-heavy portfolio, or because Instagram flippers promised Lamborghini cash flow? He's not anti-house, he's pro-math, and the math has changed. Today, a broad market ETF yields a historical 9 to 10% with zero tail risk of termites, lawsuits, or midnight water leaks. That sets a high bar for any duplex to clear. Before signing a deed, Buffett would insist on 3 filters. Clear value gap, buy at a price where rent covers pity, repairs, and pays you for management. Durable demand, jobs, population growth, landlord-friendly laws. No wishful thinking about the next Austin. Sane leverage, fixed-rate debt, you can service even if rents drop 15%. Adjustable loans and FOMO don't mix. Hit all 3, proceed. Miss one? Keep your powder dry and let somebody else gamble. Warren Buffett didn't abandon real estate because he discovered a secret flaw hidden in drywall. He left because the equation flipped. Higher costs, thinner spreads, fatter headaches. His superpower isn't clairvoyance. It's brutal honesty about opportunity cost. Every dollar chasing a struggling rental is a dollar not compounding effortlessly elsewhere. So here's the takeaway. Real estate isn't dead, but the easy money era is. If you treat property like a business budget ruthlessly and accept that landlording is management, not magic, you can still thrive. If you crave hands-off growth, the stock market may feed your wallet and your sanity better than any bungalow ever could. Buffett's final word? Opportunities come. When they do, you don't need 100 of them. You need one good one. Maybe your one good one is a foreclosure nobody else sees. Maybe it's a blue-chip index fund on sale. Whichever path you choose it for the numbers, not the narrative, because in the end, markets don't care about dreams, decor, or inspirational tweets. They care about discipline, and that's the hardest asset to buy, yet the cheapest to own. Hit all 3, proceed. Miss one? Keep your powder dry and let somebody else gamble.